So Emmerson PLC. Emmerson recently acquired a group of potash assets in Northern Morocco called the Khemisset Potash Project. I'll give you a little bit of a rundown on why we like potash. Hopefully you're familiar with it, but potash is a little bit of an overview of the company first, I guess. Just recently listed, raised £6 million in June, jumped straight into a scoping study. This is a development stage potash asset. We've got a resource that we think has the potential to host a mine life of over 20 years already. That's not the extent of the basin, that's just the resource that we have currently. There's certainly exploration upside. We put out an exploration target which gives the indication that we think it could double. Really, it doesn't really matter for the project as it currently stands. Directors have a belief that this has the potential to be a low capital cost potash development, which is very rare. And we'll get into detail as to why that's important, but also why we believe that's the case for this. The board and management, the chairman is a gentleman named Mark Connolly, has a long track record of building and operating mines in Africa. It's very important. This is a development stage potash asset. He and I have worked together before. I also have about 5 years now experience in development stage potash assets, which again, it's quite a niche industry, so it's quite important. And Morocco, in terms of Africa, is as good a jurisdiction as you're going to get. This is the board and management. As I mentioned, Mark Connolly, our chairman, Rob Rickson, the founder of the company, a couple of other key people, Enrique Sands, our geologist, ran Rio Tinto's industrial minerals business focused on potash. He's our key geo, doing all of the work on site. And Syed Hamdoui is our local partner, or a significant shareholder in the business, very well connected in Morocco, which is important in a country like Morocco. So why do we like potash? Well, these numbers are pretty clear. The world population is expected to grow by 2.4 billion people over the next 30 years. In order to feed that growing population, we have to produce more food from an ever-shrinking amount of arable land. I think everybody's familiar with this story. In terms of increasing your yield, you have to use fertilisers to do that. There are 3 key macronutrients: nitrogen, phosphorus, and potassium. And potash is the only source of potassium for use in agricultural purposes. So the long-term fundamentals for potash are very clear. It's been growing very steadily at 2 to 3% for the last 20 to 30 years, and we expect that to continue for the foreseeable future. Interestingly, in the last 2 years, we've gone into a little bit of a resurgence in the potash market. A couple of numbers that have been thrown around. The Chinese potash contract, which is traditionally the lowest price in the market, has recently been announced for this year, and it was up 26% on last year. A lot of people are missing that potash is going through a mini boom at the moment. The Brazilian market, which is the market that we're going to focus on for our project, or at least one of the markets, is up 30% in the last 12 months. Most potash producers are expecting a significant step up in that price for the rest of this year. But what's interesting is, even with that 30% increase, and even if you added another 30% increase, very, very few potash mines can be built in the current market. We'll get into a little bit of detail as to why that is. K+S built the first potash mine, the first greenfields potash mine in 50 years. They built it when the potash price was more than double what it is today. And the reason that there's only been one potash mine built in 50 years is this first point: capital cost of production. So in the time that I've spent looking at potash, the conclusion that I've come to is the first hurdle you have to clear if you want to be serious about actually building a potash mine is, can you have low capital cost production relative to your peers? And we'll go into some detail. We, as directors, see a lot of potential in Khemisset to be a low capital cost potash mine, which is incredibly rare. The second point is, how do you have a sustainable competitive advantage in an industry which is run by the 800-pound gorillas, the really big players? And when you look at the structure of the market, the second most important thing to have is a very good location relative to your end markets, i.e. you want to be very close to them. If you can be in a consuming market, that's the best place to be. If you can be in a consuming market and close to multiple other markets, that is an absolutely fantastic place to be as well. And Morocco, interestingly, is the top 5 fastest growing import markets for potash in the world, growing at an average CAGR of 80% per annum. So the market's growing at 2 to 3%, Morocco's growing at 80% per annum. That's driven by a large fertiliser company in Morocco, but really that's a domestic market that we would be able to address. And I'll give some detail as to how much of an advantage a good location can be relative to some of your peers. This is the barrier to entry that I'm talking about. This is the average capital intensity for a basket of potash projects. As you can see, the average is $1,100 per tonne of product produced. So if you want to produce 1 million tonnes of potash, you're going to be spending $1.1 billion to build that mine. Those numbers are sort of abstract, but the way to think about that is, if you assume a zero operating cost, it'll take you three years to pay off all of that capex, assuming you have no operating cost. If you start adding in 50% operating costs, i.e. you're making a 50% cash margin, which in a mining sense is a fairly large margin, it's going to take you 6 years to pay off that capex. If you then reduce that to 25%, it's going to double again. So this is the reason why nobody can make an economic return traditionally in potash developments. That's why BHP hasn't been able to build the Jansen mine. So having low capex is fundamental to being a believable story in terms of potash development. Why is location so important? This is just an analysis against a typical Canadian peer. And the reason I use Canada is it's about 1/3 of the global market for production. So if you just ignore their operating costs of their mine and just look at their transport and logistics and royalties costs, they walk out of the front door of their mine and they pay immediately a $20 to $30 a tonne, depending on potash price, royalty to the Canadian government. They then have to go 1,700 kilometres by rail to the Port of Vancouver, $40 to $45 a tonne at current prices, based on current oil, and then onto a boat in Vancouver to go around the coast to Brazil, another $30 to $35 a tonne at current freight rates, plus a cost to go through the Panama Canal for a total delivery cost, not including their operating cost, of between $95 and $130 a tonne. If you compare that to a theoretical mine in our location in Morocco, we have nominal royalties, almost nothing, but it's there at 10 cents a tonne, $8 to $10 a tonne to get it from our mine site to the port, and then $12 to $18 a tonne on a ship to get it to Brazil, for a cost saving against our Canadian peers of $75 to $110 a tonne in a potash market where the price you're receiving is $330 a tonne. So it's effectively a 33% margin advantage over your Canadian peers who produce 33% of global supply. The story is the same for, and I haven't put them on here, but the Russians are in the middle of Russia, 2,000 kilometres from a coast. They do have much lower operating cost. But what it means is, as long as you're not triple the operating cost of the Canadians, which we don't expect to be, we're going to be competitive with at least 33% of the supply in the world into Brazil. We'll be bottom quartile into Europe, and we will be the lowest cost producer into Morocco, which is a great competitive advantage to be. And interestingly, it's unerodable because you cannot remove freight and logistics costs from any of those other operations. So it is a sustainable competitive advantage that is driven fundamentally by dumb luck having a project in the right location. A little bit of detail on the Khemisset project. This is just it in numbers. It's relatively shallow for a potash mine. Still a deep underground mine, but typically Canadian potash mines over 1,000 metres deep. In the UK, there's a mine called Bulby, it's 1,200 metres deep. So 450 metres is relatively shallow. But the big point to note on this is there is no aquifer. And that really is one of the key drivers of why this has the potential to be low capex. It has a strong logistical advantage, which I just went into. We're only 90 k's to a port. That reduces significantly that transport and logistics cost. We're 300 kilometres by rail to the largest consumer of potash in Morocco. That's OCP, one of the largest fertiliser companies in the world. They have no potash production themselves. They import it all at this point in time. The basin itself is huge. We've already got a resource of 311 million tonnes, which, as I said, is enough for us to have a 20-plus year mine life, we believe, at this stage. It's been significantly de-risked already, so there's not a huge amount more money to spend on the resource itself. All of the money that we have raised is really going into understanding the technical viability of this project. And that's one of the reasons we think that we can really accelerate the development timeline. By the way, the value of that technical work that's already been done would be around $20 million today. So our market cap is effectively the value of the work that's already been done on the project. So the large resource, I think the important thing to note on this slide is the exploration target. This is based on a number of drill holes which were drilled out in that northeastern area. As I said, the basin extends significantly. We've cut it off at a depth of about 1,500 metres, which is at what we think is the upper limit in terms of depth. But as you see, the range is 260 million tonnes to 600 million tonnes. We believe this has the potential to double our resource. It won't exactly double our mine life, but there's plenty of potential to increase the scale of this project with further exploration work. So these are the key drivers of capital cost on the left-hand side, and then the key drivers of margin. And I've broken it down because a lot of people ask, well, what makes you different to every other potash mine, and why is it that you believe that you're going to be cheaper than them? So the key cost savings that you can make for a potash mine, assuming that you're an underground conventional mine, which this will be, you're not really going to save that money in terms of capital cost on the underground mine because you're buying equipment. Everyone knows what the equipment cost is. There's not that much room for us to negotiate amazing deals with equipment providers. The same goes for the process plant itself. We're going to have a bulk standard process plant that's used the world over for potash. We're not going to save a huge amount of money on that. The key cost saving items are, number one, access to mineralisation. How do you get from that surface down to the mining horizon? And number two is infrastructure. How do you get your product to the end market? And also, how do you access the infrastructure that's required to build a potash mine? And then on the margin side, it's really driven by location. If you have a mine that is relatively solid operating costs but in a fantastic location, you are going to make very good margins on this development. So we'll go into some detail on the first piece. We put out an announcement last week, which was really the first piece of the scoping study, and it addresses this first item that I was talking about, which is the access to mineralisation. And I think it flew a little bit below the radar as to what we were trying to say here. We're comparing the exact same piece of capital investment that we're going to do to get from the surface to the underground mining horizon against a basket of peers. And these are peers where you can diligence the numbers. I've put all the references in there, so you can go and look at these numbers themselves. BHP, in their annual report, said they've spent $2.6 billion sinking their shaft at Jansen. That's their Canadian potash mine. Now, it's probably not exactly $2.6 billion on the shaft sinking itself. It's probably more like $2 billion. But in any case, it's a huge number. There was a study put out by an engineering firm called Hatch, which estimates that the average cost for a Canadian potash mine to sink 2 shafts down to the mining horizon would be $1.1 billion, including a 30% contingency. And then working our way along, you've got Passport Potash, put out a DFS, $425 million to sink their shafts. Core Potash, a Republic of Congo project, nearly $180 million. And then us. The key difference between us and them, and obviously Highfield's off to the left, that's where I used to work, the key difference is no aquifer. If you remove the aquifer unit from that horizon in between your surface and the mining horizon, you no longer need to sink a shaft. The moment you have an aquifer, you have to do a technical technique which is called ground freezing. You have to freeze the column of water in a 150 metre radius. Imagine trying to freeze a huge column of water underground, the technical challenges that come with that, and also the additional cost. So the way we can access mineralisation is a simple tunnel. It's called a decline. It's a tunnel that goes down at an angle from the surface, very well understood, very widely used in coal. This is not reinventing the wheel. Our engineers are coal experts and potash experts, and they provided this number as an independent estimate of how much it would cost for us to get from the surface to the mining horizon. And by the way, that includes a 30% contingency on top of their estimated number. So that's a number that gives us a great deal of confidence that we're going to save a huge amount of money relative to all of our potash development peers. The second point that I made was access to infrastructure and how you can utilise that infrastructure is the other key area that you're going to save cost on. So this is a bulk commodity. How do you get it from your mine to your customer is fundamental to how much money you're going to make when you're in operations. We're very lucky in that we're close to the coast, and so as a result, we don't need to get to rail. The cost saving of not having to put a rail spur out to our site is enormous. So for a traditional Canadian potash mine, 50 to 75 kilometres of rail spur will cost between $100 and $150 million to install. We have, in this orange line, which you might not be able to see, is a two-lane highway each direction, no upgrades required, that runs from our project site all the way to the front door of the port. So almost no capital cost for us to access that piece of infrastructure. Potential cost saving of over $100 million. Core Potash, I often pick on them, despite the fact I think they've got one of the best geological assets. They unfortunately can't address that first hurdle, which is capital cost of production. they are 30 kilometres to the coast, but because there's no infrastructure in the Republic of Congo, in their DFS they estimate they'd have to spend $115 million in order to get their product from their mine to the coast. We would estimate, well, we have to do a 3 to 4 kilometre road connection to get to that main road. You know, in terms of, if you were building a Formula One track, it'd be $2 million a kilometre. So huge cost saving at that point. Then once you get to the coast, how do you get it onto your boat? You know, do you have port capacity available? In Canada, K+S, the Germans that just built the potash mine, realised that there was no port capacity in Vancouver. They had to build their own standalone port facility. It cost them 250 million euros to do it. We have 3 ports within 150 kilometres. Mahamedia already ships out salt today, has confirmed capacity for us to ship product today. So we already have a port solution. We have to invest in a storage facility, but it's not going to be anywhere near $250 million. It'll be sub 10 to build that storage facility. Again, another cost saving. And the next question is, how do you get power to your site? So underground conventional room and pillar, we're going to run all of our equipment off electricity. Do you need to install on-site power capacity, or can you connect to the grid? We have high voltage power lines running within 3 kilometres of our project site. We have a substation with capacity within 4 kilometres of our project site. Massive Capex saving again. In the coming months, we're going to put out discrete announcements that address each of these points that I'm raising, and we'll have comparisons against other studies so you can diligence it. But all of this is building up to that story, which is, okay, if we're saving $1 billion relative to our Canadian peers, surely our Capex is going to be significantly lower on a capital intensity basis. We've already been into this. Location is fundamental to margins. I put it on before with the slide, but if we're a solid operating cost to mine gate, we will be extremely competitive into Brazil based on current prices. Even if we were 3 times as expensive as the cheapest Canadian mine, Rockenville, we would still be making 40 to 50% EBITDA margins on this project. Now, I don't think we're going to be 3 times as expensive as a Canadian mine. We'll certainly be more expensive than them because our grade is lower. But even if we were, we would still, I'd expect, to make 40 to 50% EBITDA margin. That is a very robust mining project in anyone's eyes. And this is really the driver of why those margins exist for us. So we are not going to try and compete selling into China. We're not going to try and compete selling into India. Our key competitive advantage lies in Morocco and in all of those markets that are within close proximity to Morocco. So a mine in production in Morocco would be the closest operating mine to Brazil. The closest operating mine to Brazil. So we would have a logistics advantage over everybody into the Brazilian market. We would be the closest operating mine into South Africa. Obviously, we'd be the only operating mine in Morocco. We'd also be the closest operating mine to New Orleans, Louisiana. So the logistics advantage for the location that we have is key. And interestingly, all of those markets pay a premium to the Chinese and Indian markets. So we collect all of that premium value just because of our location. The big blue sky opportunity for fertiliser producers globally, and I think it's pretty well recognised now, is Africa is the great untapped potential. And OCP, who I referred to earlier, are really aggressively pursuing a strategy to be the fertiliser producer for Morocco. The reason that they're importing so much potassium or potash is because they're blending their own NPK fertilisers for this region. But if you have a look at the numbers, 60% of the world's uncultivated arable land is in Morocco, is in Africa. And if you have a look at the heat map that we've got here, the red is low fertiliser application rates. There's virtually no fertiliser used in Africa. It's actually significantly less than 25 kilos a hectare. All of the global fertiliser companies in the world view Africa as the next big growth story. And OCP is the one that's really capitalising on it, which is why the imports of MOP to Morocco are growing so quickly, because they're having real success in pushing out that NPK. We see ourselves as being a key supply partner to OCP for that story as it grows. They already consume virtually what we would be planning to produce annually from our mine on a year-by-year basis for that strategy. So effectively, if we were to turn on our production, OCP could consume the lot. We wouldn't do that necessarily because it's never good to have a single buyer. We would make just as good a margins going into Brazil or to Northwest Europe. But it's interesting that the demand in that market is very much growing, and they're projecting to consume upwards of 2 million tonnes a year by 2025. In terms of news flow, as I said, development stage, we've already ticked off the first news item. Here's what we're going to deliver in terms of the scoping study between now and the end of the year. Each of these, as I said, will really talk to that belief that we have that this is low capital cost. And we're going to show just how much of a cash cost saving or capital cost saving we're making at each of those items. That's going to help everybody start to say, okay, it's no longer my belief as a CEO of this company. It's now tangible items that you can all diligence, done by an independent third party who's well respected and has a lot of experience in the industry. All of that will lead up to the scoping study. There'll be other bits and pieces of news flow flowing out of this as well, but these are the really key value drivers as I see them in the lead up to that scoping study, where we will put out all of the technical detail so people can really get into the nuts and bolts of our assumptions. And probably more importantly is, what do the economics look like? What's the size of the prize? And we have a belief that with its low capex and the potential to have 50% EBITDA margins, this should look pretty good. Not going to put any numbers out there just yet. A lot of questions about Morocco. In my experience, I've been operating in Africa for 5 years, mostly in West Africa. So Cote d'Ivoire, Mali, Senegal, did a little bit in DRC. Morocco is easily the best jurisdiction that I've worked in Africa. I haven't done any work in East Africa, so I can't compare it to that. But it is a fantastic jurisdiction as far as Africa goes. Really, really pushing hard to attract foreign direct investment as it goes currently, which is reflected by their fiscal regime. So the government is not going to tell us that they want to own 20% of this project for free. They're not going to ask for massive royalties. They're really trying to attract foreign investors in, and that's reflected in the fiscal regime that they're giving us, which has the benefits of 5-year tax holidays, allows us to pay our capex back before we start paying the government, 50% corporate tax reduction if we export. They're really encouraging us to export, and virtually no royalties. So in summary, and I kept it nice and quick because we're about to get kicked out, this is a development stage project, but our current market cap is more reflective of an exploration stage. We have a board and management that has done developments in Africa and a lot of experience in potash, and Morocco is a fantastic jurisdiction to be in, and really in the next 3 to 4 months we're going to start delivering real tangible news flow that will allow people to see the fundamental value of this asset as we as a management team see it internally, and we look forward to doing that over the coming months. Very good. Well, thank you very much for coming along.